for coming back to Sonoma Brain Trust. I'm here with Chelsie Runnings of Better Home and Gardens, a real estate expert, and Daren Blonski of Sonoma Wealth Advisors, a financial expert as well. And here we are today bringing you facts over fear. We are lucky to have Nate Lamar, a trusted tax manager with Pisenti and Brinker, with us today to talk about some critical things that are going on. Nate is also, in addition to his financial acumen, musician, and he's very terrific, as well as very involved in the community. And he's a huge resource for my friends and clients of all levels, he and his firm. So with respect to facts over fear, Nate, we're hearing something about that these PPP loans may not be forgivable. What can you tell us about that?
Hi, thanks, Mary. Thanks, everybody, for having me. That was a very flattering introduction. So with regard to PPP loans, there is a lot of information, a lot of misinformation floating around. At the beginning of the PPP loan, or a little background. So the Small Business Administration, in concert with Congress, decided they needed to help small businesses that were suffering due to the pandemic, right? So they authorized $349 billion in the first round, $175 billion in the second round. The idea is that small businesses keep their employees on the payroll. Mm-hmm. Always work out every time, but that was the intent of Congress, right? Keep people from applying for benefits, keep them off of the gun, and here we're going to keep people employed with their employer. Hopefully this will all be over soon and we can, resume normal life, right? Well, so far it hasn't quite worked out that way. But the way that you get the loan is you calculate 2.5 times your monthly payroll, and including benefits, including retirement, including all these other factors, up to $100,000 per employee annualized, and that's your loan amount. So when this first came out, they said, okay, SB's giving people free money, right? We're getting businesses free money. So there was this hysteria and kind of a panic, and everybody was trying to get their applications in right away. And a lot of people did, and they're sitting on this money. And now that a lot of the loans have been funded, now the rules started to come out. And there was a lot of confusion around the rules. A lot of things changed. A lot of people decided that they didn't want the money anymore and gave it back. Now, for those of us who didn't give it back, we have all of these requirements we need to meet in order to have the loan forgiven. And that's been the big sticking point, is that it was sort of advertised as free money from the SBA. And then they said, well, there's a lot of limitations. So as the law currently stands, and keep in mind, this has been a moving target since about the end of March, and continues to change. But as of now, 75% of the loan proceeds has to be spent on payroll expenses. Now, payroll expenses are defined as wages up to $100,000 per employee annualized. So roughly for the 8-week period. And we have benefits, health benefits, particularly retirement benefits, pension contributions, and the like, rent, certain mortgage interests on real or personal property, which can be a building that you own. It can be a piece of equipment that you're paying a loan. And then lastly, utilities. So as long as all the money is spent on those things, 75% needs to be on payroll and related benefits. 25% can be rent, utilities, or interest. So that's the current law. Now, the wages forgiveness amount is also subject to 2 additional limitations. One is the full-time equivalent headcount. So as of February 15th, they're going to look at how many employees you had. And then if you have fewer employees on June 30th, then forgiveness could be reduced. So full-time equivalent is 40 hours per week. The borrower can elect to treat part-time employees as 1/2 of a full-time employee, or however, whatever of hours they are. If they're 30 hours a week, they would be a 0.75. The other limitation is that per employee, there can be no more than a 25% reduction in salary or hours. So if you have someone working 40 hours a week and you move them down to 20 hours a week, that's going to affect your ultimate loan forgiveness. So that was a lot. Any questions so far from the panel? I know I'm kind of moving fast.
Keep going, Nate. You're doing great.
Yeah.
All right. Thanks.
You're good.
So, with my colleagues, we discuss this loan often, at least on a weekly or more often. So we're analyzing this thing, and based on the current law, it feels like it's going to be next to impossible for most businesses to get 100% forgiveness. Mm-hmm. And the reason for that is because, say you're a business owner and you're looking at trying to pay your employees, and your loan is based on 2.5 months of payroll, but you only have 2 months to pay it. So if you're looking, if you have normal rent, utilities, expenses accruing throughout that 8-week period, it's going to be nearly impossible to spend 2.5 months of payroll in 2 months in order to get the forgiveness. I mean, we've done the math in many scenarios, and it's very, very difficult to reach 100%.
And it's not like you can just front load retirement payments or something.
Well, that's interesting you say that. That is a controversial area. There's nothing in the rules that say you can't, but there's nothing that says that you can. Mm-hmm. So we actually don't really know. Right. What you cannot do is front load wages or commissions or anything like that. There is a specific rule that the expenses that you're paying with the loan need to be incurred and or paid within 8 weeks. Mm-hmm. So I didn't really define the 8-week period. It's from the day you get the loan, then the clock starts ticking. You have 8 weeks, what's called the covered period, to spend all the money, right? And whatever you have left, if you're going to pay it back or you take the loan. So on the 8-week period, you have, you're trying to do the math and get all these expenses, trying to maximize your forgiveness. But I think what we're running into now is that a lot of businesses, particularly hospitality businesses, obviously the tasting rooms all just open back up on a very limited basis, right? So they're operating nowhere at full capacity. Restaurants are operating nowhere at full capacity. And so for a lot of borrowers, that 8-week period is coming to an end very quickly here. The money started getting dispersed around the beginning of April, and here we are, it's the beginning of June. So our 8-week period is just about here. And the difficulty now is, I can't resume my normal businesses to be able to keep all these folks on, as of June 30th. So say your 8-week period ends in early June, and then they're going to look at, your June 30th full-time head count. And if you're not able to resume your business in a manner that allows you to keep all these folks on payroll by the time the funds run out, that's going to kill your forgiveness as well. So, if you had 10 employees at the beginning of the year and now you only have 5 because you can't pay these people for not working, that's going to kill your forgiveness. So now that I've said all that, the House just passed a law last week. It's expected to get picked up in the Senate as well. The first thing it will do, most importantly, is extend the 8-week period to 24 weeks. So instead of, trying to figure out how you can spend all that money in such a short period of time, you can stretch it out, right? So much easier to attain forgiveness in that scenario. It also removes the 75% payroll requirement. So if you spend half on payroll and half on rent, especially if you're, we have an office on the square in Sonoma, right? I mean, That's not cheap rent over there. So that would be a lot easier for, especially like a, maybe a really small business or a sole proprietor, they're just a mom and pop shop. Instead of having to pay 75% in wages, which might be, unthinkable or impossible. They'll be able to spread that out and spend it on what they need, right? As opposed to being forced into a certain mold that may not fit them. And then lastly, this bill would create some more exceptions to the full-time equivalent rule. If you are unable to either rehire the same people, find similarly qualified employees, or unable to resume the level of business, you won't get penalized for the full-time equivalent reduction. So that could be big, especially for restaurants. You get 24 weeks, so you can keep people on some kind of payroll maybe, or, if you're not resuming your same level of business, they're not going to penalize you for laying off people that you can't keep busy. So we're hoping that the Senate is going to pass this week as well. Hopefully Trump will sign it. He seems to have kind of gotten on board with most of this stuff. So we're hoping that this gets easier. Or, if it were up to me, I'd say just, if you're under $1 million, forgive the whole thing. If you're over, just, ease the restrictions quite a bit. So especially considering how it was advertised early on. But as of now, the forgiveness is a big issue. It's going to be a big hurdle. It's going to require a lot of pretty intense calculations, especially, if you have 100 employees, you have to calculate forgiveness on an employee by employee basis, subject to all these rules and limitations as it stands now. So that could be a very arduous process. Fortunately, we have been, Pisenti Brinker, we've been spending a lot of time with this thing, consulting with experts, colleagues from other firms, and we are putting together some kind of a package that we can provide that will enable people to make the calculations. That's still under development, but we're hoping to have that rolled out here in the next couple weeks. So, that's kind of the overview. There's really a lot going on, and it's like I said, it's been 6, 7, 8 weeks since we've been following this thing, and it's definitely a moving target. And should mention is your 8-week covered period. You have the loan, you're a borrower's loan. You have 6 months from the end of the covered period to apply for forgiveness. Mm-hmm. So the approach that we're taking now is wait it out. There's no reason to go applying for forgiveness when it might not be the most favorable scenario for you to do so. So after 6 months from the end of the covered period, then technically the loan becomes due. You think you have like a 2-year window to make the payments if you do end up with the loan. But interest and principal is deferred for 6 months from the end of your covered period. So we're thinking, let's wait it out. Let's see if the government comes through with any more helpful provisions that will forgive. Like I said, hoping things are going to get better for the borrowers. Any questions from the panel?
I'm wondering, do you have any idea what the interest rates are, what you're seeing the interest rates are on these loans?
Yeah, it's 1%.
1%? Just across the board, it's all 1%?
Yeah, all the PPP loans are 1%. Now, there are several other SBA programs. There are other loans for bigger dollar amounts generally that have a little bit higher interest rates. But for the paycheck program, it's 1%.
And Nate, how are they going to be looked at when you're dealing with people's taxes? Like, is this going to be considered income, or at what point will it be looked at? Do you have any idea, or maybe that's still?
Yeah, so that's a good question. As of right now, the IRS and California have both come out saying that if you have forgiven loan proceeds, that will not count as income. However, the caveat there, and there's always the caveat, right? The IRS did come out and say that if, to the extent that you pay expenses with forgiven loan amounts, those will not be allowed as deductions on your tax return. So that was a little bait and switch also, where they're saying, oh, this is tax-free money, but as it turns out, it's not. So that could be a big deal to a lot of people. If you have $1 million forgiven, that's $1 million of net income on your bottom line on your tax return. So yeah, that's why a lot of folks, were giving the money back too. It's like, well, it's going to cost me $350,000 to get the free $1 million, and that's not really worth it. So that's the state of that. Yeah. And we're hoping too that the IRS will recant, although it's hard to say. It's really hard to say.
So it sounds like, Nate, the strategy is, if you take it, there's no guarantees. You have no idea really what you're signing up for. So if you have to take it, take it. Otherwise, probably better to sit the sideline on this one.
Exactly. That's what I've been telling my clients. I have one client in particular who's a restaurant in San Francisco, and they were caught up in the mania at the beginning. They got their application in, they got the money. They're like, hey, can we pay ourselves? And according to the rules that were there at the time, yeah, you can pay yourself. But then more rules came out that said, well, you can pay yourself, but oh, by the way, if your 2019 income was lower, then you're going to be stuck to that limitation as well. For owners, that's something I should touch on as well. In an S corporation, your owners are eligible to receive wages and benefits up to 18 compensation. For partners, owners in an LLC, for example, in a partnership, you're able to receive wages, you're able to receive payments up to $100,000 or 2019 self-employment income. So if your 2019 self-employment income happened to be low, then you're going to have massive limitations. In the case of my client, their 2019 income was pretty low for their partnership, like probably around $5,000. So, then you have to annualize that. So 8 weeks worth of $5,000 per year, multiply it again by the self-employment tax percentage. So they could pay themselves about $300 that would be forgivable. So that was a rule that came out around the end of May that really stuck it to a lot of folks who were just trying to get by. So looking for relief there. Don't see it coming yet, but again, this is a moving target, and we're hoping for the best.
What's interesting, can you hear me okay?
Yeah.
Yeah.
What's interesting is it's, kind of the way it sounds like they have this thing set up, that the only organization that would truly want to take this at the end of the day is someone who has no other option. They're up a creek anyway. And so here we're loaning taxpayer money out to organizations that are probably going to have a solvency issue anyway, unless this COVID virus just dissipates out of nowhere. So it'll be interesting to see how many organizations it actually helps bridge them versus just kind of the last straw for them and keeps them going for a few months, but there's really not the ability to, perpetuate and build their business beyond.
Right. I agree with that. I think there will be insolvency on these things will definitely be a problem, especially if the pandemic continues on, as some expect throughout the end of the year. When the PPP deal was written, they're thinking, okay, 8 weeks, that's probably long enough, right? Where, it's going to shut down and, things are going to start to reopen and, we'll get back to business as usual. Although for a lot of folks, especially around here, we're not back to business as usual yet. And it might be a while before we are, right? So that's why we are, definitely looking for additional paths to forgiveness here, because for a lot of folks, it's going to be really hard to get. And I agree with you. I think, if a business is struggling 3 months ago, 4 months ago, chances are the PPP loan's just going to, kind of put a Band-Aid on a worse problem. It'll get them a couple more months down the road, and then they'll be right back where they started.
And then I've just been watching over the last 3 or 4 days, just the number of businesses getting just destroyed by the riots, right? And in LA, and we had them in Fairfield yesterday. We had a bunch of businesses trashed, and gosh, you just can't get a break for some of these businesses, it feels like, because they're already on edge, and then their windows get broken in. There's no money to replace those windows. So what do? You just fold up shop. It's really a difficult time for people.
Well, they
Absolutely
probably have some type of insurance to cover, destruction to buildings. But yeah, I mean, it is definitely a tough time.
It'd be interesting, actually, in our conversation, to get an insurance broker on our conversations and ask them, because I've heard rumors that a lot of these riot pieces are not covered under some policies. So it'd be really interesting to see what is covered and how all that plays in this whole story that's unfolding in front of us right now.
Yeah, and we have some great insurance brokers here in town too. But yeah, absolutely. So Nate, with the PPP application, do people have to pledge like a personal guarantee or something? So what happens if they can't pay it back?
No, there's no personal guarantee that I'm aware of. That's probably just needs to be ironed out at some point, because I think it was under the impression that, okay, it's a loan. Technically, it's probably forgivable. Otherwise, you have 2 years at 1% to pay it back. So that was disclosed early on, although I think the forgiveness part was a little bit maybe overstated, how easy it would be. But to my knowledge, no personal guarantees are necessary. It's backed up by the SBA.
I've heard this is kind of a more technical question, Nate, but I've heard a lot of questions and discussion around the whole paid requirement during the 8 weeks. And a lot of businesses are really paying really close attention to what's deemed paid, right? Because you got to get that money out within that 8-week period, at least under the current rules. And so one of the strategies I've heard, and feel free to dodge this question if it's too specific for a forum like this, but one of the strategies for a small business is really just getting that money out of the account into a personal account that is deemed paid for purposes of satisfying the 8-week rule. Is that correct?
Maybe partially. My understanding of it is you really have to document where that money goes. So, for example, if it goes from a business account to a personal account of an owner, you're probably not going to be able to call that a forgivable amount. Now, if you say it goes into an account of the owner and then he pays people from there, might be able to get away with that, although I don't recommend it. Kind of best practices here. A lot of folks are recommending putting the PPP funds in a separate bank account, and so that way, when you're making qualified expenditures, then it's really easy to track. Or if you use QuickBooks, you can assign a class within QuickBooks to track PPP funds as well. That's another good way to go for tracking if the bank account option is not there. So say you got money in the bank, you're running payroll, you transfer the exact payroll amount from your PPP fund into your normal bank account, and then write checks from there. Just a really, really clean, really simple way to keep track. So that, for lack of a better option, that's what we're recommending.
Okay. Yeah.
Now, I mean, if you had maybe a self-employed individual who got PPP funds, and he's paying himself enough within the limitations, you may be able to get away with that. But again, it's just spending the money isn't going to be enough. I think this is the bottom line.
Yep.
And now, Nate, you were talking earlier about your specialty in general. You're advising a lot of businesses, partnerships, and what else are you doing day to day?
Well, so at Pisenti Brinker, we're a pretty middle market. So, you know, we're kind of lots of small businesses, family-owned businesses, closely held businesses. So we run kind of in the, say, maybe gross receipts from maybe $250,000 up to about, on average, about 10 to 20 million. So we stay rather small businesses. That's my preference also. I like direct contact with my clients. I like to be able to, ask them questions. I like for them to be able to ask me questions, develop a relationship that way. So we understand each other and that we can work together towards the best results. On a day-to-day basis, right now, a lot of the PPP stuff, I'm getting a lot of questions on a daily basis there. Also just, trying to keep tax work moving through, getting clients taken care of, getting refunds for clients. As part of the CARES Act, the IRS reinstated net operating loss carrybacks for 2018. So we're going through our clients and identifying which folks might be able to get refunds from losses incurred in a couple years ago. So that's, we are heavily focused on trying to put cash into our clients' hands to the extent that we can. I know another big change that they just made was with qualified improvement property. Kind of a situation in the Tax Cuts and Jobs Act that was passed in 2017 was they changed the definition of qualified improvement property to be 39-year property instead of 15-year property. And I know this is kind of technical and heady, but basically what it means is that the improvements to a building were no longer eligible for the bonus depreciation, which is now 100%, which means you can write off the entire amount in the year that you do it. So they revised that rule to allow improvements to go for 15-year depreciation, which could also be a huge windfall for our clients, right? So if they spent, a couple $100,000 improving a building, now they'd be eligible to write the whole thing off instead of spreading out the deduction over 39 years. So we're looking at that as well, trying to identify clients who can benefit from these new provisions.
I'm glad there's people like you, Nate.
Thanks, man. Thank you.
I appreciate your profession greatly.
Yeah, Nate's fantastic. Well, thank you so much, Nate, for your time and for your firm supporting you, coming and talking with us today. I know on behalf of the panel, we really appreciate you and your efforts and for doing this. So hopefully we can bring you back as more questions arise, and keeping in mind your timelines with the tax deadlines too. So
absolutely. Thank you for having me. It was a pleasure, and I look forward to speaking to you again.
Thanks, Nate. Appreciate you.